I totally agree with that. A lot. It has obviously for obvious reasons. Multifamily has been very very hard over the last couple of years, and people can jump into other asset classes, and that is one of the reasons why we were exploring assisted living.
This is the Multifamily Journey Podcast, show 21.
You're listening to the Multifamily Journey Podcast. In this show, you'll hear industry experts share tips of success and failure from their real estate investing journeys. You'll get a transparent look behind the curtain while you learn to fulfill the lifestyle you want to live and achieve your wealth goals. Get ready for the journey to financial freedom through investing in multifamily real estate. Here's your host, Blake Dailey.
Hey, what's up, everybody? Welcome back to the Multifamily Journey Podcast. I'm your host, Blake Dailey. And today, again, as always, got an awesome show. We got Prashant on today, and he shares just what I think is some really cool stuff. Talks about a pivot he and his partners are making into assisted living facilities. And we talk about like the reason behind that is because oftentimes, and especially right now, like multifamily, it seems, is getting a little bit competitive, almost too competitive. Not that you can't find deals, but it's harder, right? And because of that, a lot of people are flooding the market, different things behind that. But there's these asset classes that are like closely related to multifamily, like, I don't know, self-storage and mobile home parks, assisted living facilities, stuff like that, that kind of run on the same principles, but have these nuances that make it hard and, because of that, make people not get into it. So really good stuff today. And you're going to hear all about that. And then what I really liked about this episode too, was he dug into how he brings people into his world and gets to share opportunities and grow his network of investors and keep this thing rolling, right? The snowball for him is rolling down the hill. And for him, it all comes down to a few things. One, it's education. You gotta put out content, put out value, like true, genuine value to make people aware of you and really just grow an audience. And then after that, it's continuing to nurture, create relationships. And that relationship is ultimately what leads to people investing and partnering and deals and all this other kind of stuff. And you do that through online meetups, podcasts like this. I mean, really good stuff. So we're going to get into all of that. And I think you guys are going to like it. And just real quick, before we get into the show, I think, on this topic is education. So one thing I do on multifamilyjourney.com is I have free educational materials out there, whether you are looking to be a passive investor or active investor. There's toolkits out there for each of those. You can learn about what it takes to be passive and things that can make you successful in that space, and then active as well. And obviously there's the getting started in multifamily checklist, where that kind of breaks down everything from, the market to talking to brokers to the beginning steps and creating your business. So a lot of good stuff up there on multifamilyjourney.com. You can go check that out. And that's the end of my spiel. So I guess with that, let's get into the show. All right, Prashant, welcome to the show. It's good to have you here.
Blake, thank you so much for having me here. I'm honored. Thank you.
Yeah, I'm excited for this show. We're going to get into a lot of good stuff. But before we do, why don't you give people a little bit about your background and how you got started on your real estate journey?
So I have a very humble background. I came from India in 1998 with $150 in my pocket. And I come from a very, very good college from India, like second in 70,000 students, so to say. So from that perspective, I was a very strong technology savvy person. I worked in many, many companies all my life, 25 years, in the management and technology sector, right? And I was always getting paid a lot. But over the last couple of years, I started realizing when I don't work, I don't get paid. So it's like a golden handcuff, you get paid so much, you cannot quit the job at the same time. But when you don't work, there's nothing residual left for you. That's when the real estate came around, and I started investing into small single families, very small single families. But long story short, you realize that you cannot scale that business. You cannot buy to replace my income. It would take like 20 years, for me to buy 200 home one by one. I said, I'm going to scale it very fast. I bought a Same year I jumped into multifamily. I bought 24 unit for myself in Texas. And and again, when money starts drying up, you cannot keep on just buying properties for yourself, right? So then I realized that I have to jump into something where I can help others to gain the benefit of this, of the knowledge that I have gained. That's how I came into syndication.
Yeah,
So
yeah, I love it. That's a great story. And I think you started where a lot of people do, right? Either being, I don't know, discontent with their current job or whatever, they feel tied to it. They, if they don't work, they don't make money. And the great thing about real estate is, like you just enlightened on, is that you create passive income coming in whether you're working or not. So you could stop today and continue to make money, but obviously you want to keep building that and bringing on more investors and spreading that wealth. So I love that. And then you mentioned too, like you started where most people start, like after that realization, is in single family. I did the same thing and then realized pretty quickly it's not scalable. You can make a big jump if you're flipping houses or whatever, and that active income. But I think to build up 1,200 units that you have now, if you had 1,200 single family houses, you'd have a very inefficient portfolio. So yeah, can you speak to that side of things and why multifamily was a better route for you?
see, multifamily, is such a great asset class. You are not tied. You have 500 unit apartment complex. If 5 people leave or 1 people leave, it doesn't impact your cash flow. It just impacts your cash flow very little. While in a single family, you have one tenant and he leaves, you are like, there's no cash flow there, right? So you are spreading the risk. Everybody needs place to live, right? Recession happens, where do people go? People go sell their homes. They go live in apartment complexes, right? So it's such a great asset class, which gives you all the benefits. It gives you the pride of owning the real estate, which a lot of people have. I have the pride of owning the real estate. I own this much. So everybody has that kind of pride. It gives you that pride. It gives you the benefits that you get from single family investing. It spreads your risk. It gives you the cash flow from day one. And the most important part is, it is not evaluated based on your personal income. You are getting into multifamily. I may not be earning that much in my personal job, W2 job, but I can go buy in a $5 million project, 100 units very easily, as long as the income being produced by that asset takes care of the debt service.
Yeah.
Right. So that is, anybody can buy multifamily for that matter. I truly, it's such a magic thing. And then on top of that, you have cash flow, you have appreciation. And then the most important thing is the depreciation that you can take. You can depreciate.
That's a big overlooked benefit.
Yeah.
I think,
So in our projections, we don't talk about the tax deductions because we are not allowed to, because we are not CPAs and all that. But there's a fundamental benefit of bonus depreciation and cost segregation that can almost write off your income as well as some part of your principal also.
Yeah. Which I think also is like a huge benefit when you're raising money from accredited investors, because these are high income earners, that depreciation does huge things for them in order to reduce their tax burden. So, I think that's a good transition point too. So how do you're syndicating these because you're raising money to complete these large multifamily projects. So how do you even start to build those relationships and start syndicating with people like this?
It is a very organic process, as you know, Blake, more than I do. You are into this business also. It's a very, very organic process. Nobody is going to give me the money unless I put myself out there and become a thought leader, right? So it's a process where you are educating. A lot of people are out there who have a lot of money. Everybody has money in their bank accounts, and a lot of them do not know what to do. Maybe they just invest in stock market, and many times they don't end up making even 5% on their money, right? Mm-hmm. But in real estate, you almost, I'm not saying a guarantee, because it is not guaranteed, but you are an equity investor. You are getting the fundamental benefits of real estate investing. So it is very important for us as syndicators to educate our investors and continue to educate them on an ongoing basis. And it's like one at a time. It's a very tedious job,
Yeah,
but
bringing them into your world through this
yeah,
education. Yeah.
once you start bringing them in, you will realize that it starts snowballing. You have an investor, you have taken care of him very well for a year or two, then he knows that he's going to invest money. He's an investor for life, and he brings other investors, and so on. So you are continuing to add one or two investors. I mean, I'm very conservatively, maybe one or two investors per quarter. At the end of the year, you'll have four, and next year you'll have eight, and those four will bring another one at a time. So, that's, in a couple of years, you will have 50, 60, 100 investors.
Yeah. Yeah. I think it grows exponentially, just like everything else, like your number of units and just, your experience and your availability to bring on and your ability to bring on more investors just compounds. And I think it's really good. You started with the education piece. Like for you, that's the fundamental piece is educating investors to bring them into your world. So, and I know you host this online meetup and do a lot of engagement with potential investors and investors online. So how is hosting and just attending, for those that maybe can't host yet, but how is just doing that with online meetups been really helpful for your business so far?
See, I will tell you, when I started like 2 years, 3 years ago, I was doing my only educational sharing, right? I'll just come in and talk, whatever my experience was, and I will share the knowledge. And I had a deal after that. And I never asked for money from any of the investors. And I got most of my money from the folks whom I mentored, right? It came from nowhere. So in my mind, when people are looking at you all the time and they are asking questions, they are starting to trust you. You have become a thought leader. Irrespective of irrespective of anything else, they have built a relationship with you. And and that relationship comes handy when you have a deal. You're not pitching them only, you are pitching to the whole world. So to say, if it is a 506C, if it is a 506B, you are pitching to a closed circle, but you are in general pitching it to everybody. But those who have established that connection with you, they have more trust with you. And trust me, it has helped me a lot. People just come from nowhere. They say, "Oh, Prashant, I track you all the time, and here it is, $50,000 check. Here it is, $100,000 check."
Yeah. So it comes from building trust online, being that voice, that trustworthy face through your online engagement, and through that, like people feel like they know you, and automatically when they see your offerings and stuff like that, they want to invest with you. Is that kind of what you've seen happen?
It is very important for you to be extremely genuine in your communication, extremely genuine in your heart. If you are trying to be salesy, you know how car salesmen are. People don't trust them when they go buy the car. But here you are establishing a relationship. You are trying to become a friend for life. And yes, this is exactly what I'm saying, what you said.
Okay, that's good. And I think for somebody like starting out, getting online and putting themselves out there, or just being, a person that shows up to these things to learn, what kind of things can you expect from these meetups? What kind of connections? Is this a place just to get passive investors, or is this a place to, go out and meet partners? Like, I think everything's changing now. So how have you seen it kind of evolved in the last year online?
It changes everything. Everything has changed. Everything is coming online. The more you are interacting with people online, the more you are providing value, the more you are getting the value back. So if we go with a mindset of giving, we get it back, right? So if I'm putting myself out there, the nature gives me back automatically, right? So I'm on so many podcasts. I'm getting deal through podcasts, like I'm talking to you. Maybe I'll get a deal from you, or maybe you will invest with me. Trust me, I'm getting real deal. People are bringing with the deal. Prashant, this is the deal. Do you want to invest with us, or do you want to work together? So through the podcast, you are getting the deals. Through the meetups, you are getting investors, and you are sharing your deals in your meetup also. So everything is kind of complementing each other. Not going out of the house at all. Except to do the due diligence on the property, but it's all happening online now. And for all practical purposes, it happens in person better for sure. But we are not meeting in person right now, but that is a little bit adverse. There are some little adverse effects, but it's okay. I mean, it's working out.
Yeah. And there's this quote I heard on this topic, and I think it was Grant Cardone, but he says it's not the best, it's the best known. So, I mean, the more you can get yourself out there, the more connections you can make via online meetups or in-person meetups. I mean, the more chance you're going to get to find a partner or find a deal. Like you're saying, like through these meetups and podcasts, you found deals and you've had people email or call you and say, "Hey, I trust you through what I've seen about you. I want to invest with you now." So I think that's really good.
Yeah.
Okay. So once you know you're going to go the online medium to find people, deals, whatever, how do you select the target demographic? I guess specifically with raising money, how do you target specific people online? I don't want to make that sound like you got them in your scopes or anything, but obviously you got to find like a certain kind of people that you want to engage with. So how have you been able to foster kind of your community online?
See, I have created a funnel for myself. Okay, myrealtygains.com. That's my education website, where I have 3 levels. Right, one is when somebody goes there, they subscribe to my 7-day passive email course. It is a education emails that they get for 7 consecutive days. Right. From there, the next step is for them to join my Passionate Passive Investors Club, which is the second step. So I have 100 people here on the top, and then by the time Passionate Passive Investor Club comes, they are like, maybe 15 are left there, and it's all free. I mean, there's nothing. I mean, I'm not asking them to buy something or anything. Once they are there, they have a little more in-depth knowledge, and then they schedule a call with me. So by the time they are ready to schedule a call with me, they have already learned a little bit from me on YouTube or on my investor club or through my emails. And when I'm talking to them, it's all about building the relationship. It's not about educating them. I'm all for education, but these videos, they help them out anyway. I mean, why to repeat the same thing over and over again? So they kind of connect that relationship. Once that relationship is established, that's it. I mean, when the deal comes, it goes to them, and then, I mean, I don't ask them to invest, but if they have money, they trust me, they will invest in it, basically.
Yeah, that's really good. Just to break that down a little bit. So it all comes back to the education, right? Through My Realty Gains that you're talking about, your website starts with the education there on YouTube, whatever that medium is. I mean, it can be a million different things. It could be hosting a local meetup. It could be, I don't know. I mean, people post like how-to videos on TikTok now. It could be that, like, hey, how to invest in apartments on TikTok. So that educate, and then bring them into the investor club to kind of foster the community, further the education that's more specific. And then the call that's where the relationship building. So you got the education, build that relationship, solidify that trust, and then invest. So it's like that's your funnel to get them down to this. And really it's about building relationships and finding the right people.
Yeah, to me, funnel, I just call it funnel, but it's more psychological, right? You are building the real trust in that call, and then those folks are there. If they are ready to invest, they invest. If they are not, they're not. So I think that's just a social way of interacting with people. Besides that, once you have gotten to know people, it's not they. I mean, they are going to take it further also to their friends and family members.
Yeah.
So as you said, it's a snowball effect.
Yeah, I like that. It's just a genuine approach to bringing people into your world and providing education and providing, that means of financial gain for everybody that decides to follow through. So I like that a lot. I like that. Okay. So just transitioning from that point, I understand your superpower is in underwriting and finding ways to make properties operate more efficiently. So can you just talk on that for a little bit?
So I must say that, we look at, so in this business, there are 2 things. One is deals flow and one is investors, right? 2 things are needed all the time. It's very important to work on both of them at the same time. If you're working on one, you're missing out on the other, right? So we connect with brokers all the time, and they send us deals all the time, and we spend a lot of time on these deals to underwrite them. And out of 100 properties, you probably put a LOI on 10 of them, and out of 10, you end up putting one in the contract, one or two in the contract, and then
Another funnel.
another funnel, yes. So, basically, right, for obvious reasons, last year, 2020 was not the best year, and because we were too conservative, we didn't want to take any risks, and even going forward, also we are very, very conservative, so to say. To be able,
how I think this is a really good point. Like, how are you guys being conservative? Because I think, you hear that blasted across the board. And then, I've just through like what I've done making connections, I've seen some people's underwriting, and I'm like, that's not actually that conservative. So I'd like to see how, what you guys view as conservative, just for, the people listening.
There are a couple of things. Okay. There are a couple of things. One is, the moment you buy you put like 2%, rental, your rent, 2 or 3% rent increase. So in a conservative approach, you may end up putting 0 for first year or 2 years or 1%. So that's the most important. You're not there to project the increased income right away. That's number one. Your expenses, however, may go up, right? So number two, so that's the most important part. Number two, your cap rate, the cap rate you are buying, and your exit cap rate, there has to be a decompression there. If you are trying to compress.
And the reason that is, Prashant, I just want to make sure everybody understands is because if you're going to be conservative on your cap rate, that's how your value is determined in multifamily. So if you're, expecting a really low cap rate, which would make your value higher, maybe be conservative, that cap rate's going to go up because there's more risk associated with the deal. Therefore, your value is going to go down. Yeah. We've talked about that in previous episodes, but basically value is determined by the cap rate.
Yeah, both the things, one is your income growth that you project 2 to 3%. You have to be extremely conservative on that. Number two, your exit cap rate has to be conservative. It has to be higher than what it is today. And number three, the refinance. If you are refinancing in year 3 or something, you have to find, you have to make sure that you put the right, you have to be conservative on the loan that you are going to get in 3 years. Who knows what is going to, right now the loans are pretty cheap, but who knows after 3 years, what are they going to be?
Yeah, that rate could very well be higher, 2-3 years.
And the cash reserves, right now, you need like 9 to 12 months worth of reserves. How you are gonna, basically you need to have that kind of money in your pocket. So basically making sure in all these numbers, you are not over projecting. You are not trying to lure the investors. So the most important thing for investors is the preservation of capital, not the income on their capital. Income on the capital is just the secondary piece. Trust me.
Yeah, that's really important. I think people want to make sure that they don't lose money before making money, right? There's a higher aversion to losing than to gaining. So yeah. So
if I'm given 2 deals, one is 12% return and one is 7%. And if I'm an educated investor and all the parameters being same on the deal, I probably would go for a 7% because I know 12%. Those who are projecting 12%. They may not be, if the parameters are same, they may be over projecting it. So for me, in my mind, under promise is more important than over promising.
Yeah. I think whenever you're looking to raise capital, it's always important to under promise and over deliver. Because you talk about, you were talking earlier about when you bring on 1 or 2 investors and then they tell a friend or a family member that turns into 4 investors, you never get that. You never get that compound effect if you promise people a 15% return and then they get a 14% return. Just that little bit that you underperformed, it can make a big difference. But if you project 14 and you hit 15, wow, they just got a 1% bonus because of how well Prashant did or how well Blake did in operating this deal. And then they want to tell everybody about it.
And it's all psychological to your point. I mean, 14 to 15, 15 to 14 makes a difference, and 14 to 15 makes a difference. So, I mean, it would have been better that you had promised 12, then you are getting 14, rather than projecting 15 and getting 14, right? So, I mean, trust me, I get all the calls. Sometimes, we are not able to pay in one quarter or whatever. Investors are like, Prashant, what's going on? You know what I mean?
Yeah.
But when you pay extra, then they get happy. So always, setting the expectations up front. That's the key in this business.
I think that's good. Sometimes you have to stop distribution so that you can have the cash on hand to weather storms, like a lot of firms did in early March. And then, you can still hit the return on the back end. But if you're pumping out cash in the meantime, then have no money for if something happens and you're in a bad spot. Did you guys have to deal with that in the last year and at some point stopping distributions?
Yeah. We ended up having a deal in that, we had to stop the distribution for a quarter. But we did the refi in that year itself. So investors ended up getting more money, but they were not that they were not happy. It's just that they always thought that 8 pref means 2% per quarter that was assured. And even though we explained them, but some people don't understand what.
It makes them a little unsettled, right? Because a lot of people get into this for passive income, and if the passive income is coming, then they get a little weary. But I think you probably made the right decision, because if you can't produce the return on the back end and actually preserve that capital and hit that whatever the hold period is, the return metric, then they're going to be a lot unhappier. And if they have to weather it for a few months, you guys, take a shot in the shorts, but you do everything with integrity and make sure everybody preserves their capital. It's going to speak volumes at the end of the deal.
There is no better asset class for building wealth than real estate. And in most instances, people don't have the time or energy to invest in it on their own. So how do you build wealth with real estate when you lack the time and energy? Leave that to the Growth View Properties. The Growth View team finds, negotiates, and manages multifamily assets for private investors. Their mission is to help investors secure the ultimate asset, which is time, all the while impacting the greater good with their endowment fund that fuels the mission of charitable organizations. Find out more by going to thegrowthview.com. That's view with a VUE.com. Put your money to work so you don't have to at thegrowthview.com.
Yeah, that is correct. That's what it is. You just have to be as transparent as possible in your communication, and you are showing the balance sheet also in the report, monthly report, that even though we are not paying you, the money is sitting there waiting for the stormy days. Who knows?
Yeah, that's good. So right there, we're just talking about, how you preserve the income and be conservative on what's coming in. But as far as, what's going out, the expenses, like what inefficiencies do you look for in multifamily properties that you underwrite? And, especially those areas where, you can go in and easily create value by boosting the NOI.
Yeah. So the most important thing is, we have to see the situation, where the seller is. Why is seller willing to get out? There are situations when seller is willing to get out because, they have bought another asset, and they want to get out, and they don't have any capital left to inject in the current property. So they have brought the property to a certain stage, or the property is distressed. What we are trying to see is what is out there in the area, what are the rent comps, and how we can get to them. That is the real underwriting, right? That's what the business is all about, and how we can improve that rent collection from where it is today to where it can be. That's all the business is. There are multiple factors, your boots on the ground, your management companies, or maybe deferred maintenance, or, rents not up to the market. So all we try to do in this business is look at all those aspects and see where can we improve the rent. Because that rent increase is going to create higher NOI. It will create higher.
Okay. So you guys are more focused on buying not bad properties, but properties that have this distress because whatever that situation is, and getting the rent back up to market level rather than cutting a bunch of stuff.
Yeah. Cutting a bunch of stuff is not a real key, because you have tenants living there already.
Yeah.
So you are not really stopping to give them what they already have. You are providing them more value so that they can have better experience.
Yeah. And so that they'll pay higher rent. Yeah, that's good.
Yeah, that's where it is. And if we have to cut something, maybe we'll cut something also, but we haven't done that yet.
Yeah, that's good. So as far as the income growth is concerned, I think this will be a good little piece to break out for the people listening that might not know like what that market rent can get up to. So what are some things you and your partners do to determine what that new level can be with the rent growth?
Yeah, so the most important thing is in the underwriting, you are determining the amenities, right? You are looking at the comparable assets in that asset class and trying to see what is the rents that are coming out of those properties and what are the amenities that are being offered in those comp. So that comparison is a very important part, right? I mean, and then you try to evaluate, if we add, maybe a dog park, or maybe put stainless steel appliances, maybe there is a need for maybe the area is gentrifying and this property is not is the sore, it's not, I mean, the sore in the eye. So that's where maybe we need to do the more bigger rehab on this. So the goal is to how we can improve what amenities are comparable, and by providing extra, like washer and dryer hookup. Sometimes, you can even provide rentals, washer and dryers also. That's where you make some money. Sometimes you are providing even rental insurance also. That's where you may get some money also. So there are various ways you can improve your NOI. We don't try to do nickel and dime. We try to put it on the basic side. What is the experience? What is the class of our asset? And as we do that, I mean, invariably, all the assets can have some value add component.
Yeah. I feel like we could have like a whole episode on that, like how to increase the rent on a property. But just to summarize what you're just saying, basically it's look at the amenities available at the property, and then, the comps in the market, like what similar properties, what kind of amenities they have, and either matching that or exceeding that to create growth. Because if people have more at property A than property B, they'll pay more for the amenities at property A. I think that's really good. And with work from home situations and anything like that, have you seen any shift in amenities? Like over the last year, amenities people pay more for now because of COVID and everything that's happened?
I must say that because of the COVID, our rentals have been full. I mean, we haven't had a problem, in terms of the collection. I know a lot of people have a lot of troubles, but because of the asset classes that we are in, so right now, we had very little or no impact. But to your point, people have paid more. Maybe they have. I have yet to look at that. I have not seen that trend too much, because I mean, part of the reason is we have not tried to take advantage of the situation. Also, we in our mind, in our business, as I said, we are not nickel and diming at anybody.
Yeah. I was thinking more along the lines, if people are paying, if people will now pay more for a 3-bedroom than they would for a 2-bedroom because of a home office, or more for a 2-bedroom than a 1-bedroom, little things like that. I was just curious if you'd seen a shift and stuff like that. Yeah,
there's definitely a need for the bigger, 3-bedroom or 2-bedrooms. That has been a stable need. But we have not increased the rents for sure this year at all.
Just to keep them occupied and people paying, because that's the biggest risk you run right now, is people sitting in there and not paying.
Yeah. So overall, I think it has not been that bad. I mean, yes, the demand has been consistent, stable demand on 3-bedrooms and 2-bedrooms.
Yeah.
And there are people who don't work at all, so they are still in 1-bedroom,
Yeah.
So,
that's really good. That's good. And the multifamily portfolio seems to be performing really, really well. And I want to bring out this too, because I know you're making a little shift, or maybe addition, by focusing on assisted living facilities now and syndicating those as well. So why that switch? I'm interested in this one.
Yeah. So as I said, I have a mental thing to help seniors, we always lived with our grandparents, took care of them until they moved on. So I always had that feeling in the heart to take care of our seniors. And because of that, I always wanted to see what can I do. And the opportunity came across. I met an operator, and the operator, became a partner. So we bought few single family businesses, assisted living businesses. The goal is something more humble than just making a business out of it. Eventually, it will become a business out of it. Right now, we have 3, 4 facilities where we are adding. We are buying we have bought businesses, and we are buying some more with our own money. But eventually, it will become more of a syndication model
Yeah.
too. We are testing the waters. How much can we generate for our investors? Things like that.
Yeah.
Um,
Yeah. It's an interesting asset class for sure. Cause I know there can be higher returns because there's a little bit more work and like there's the nuance to it. And, normally whenever something is harder, right, it keeps people out of it because they want, people want what's easy. They're like water flowing around the rocks, the path of least resistance. But yeah, I mean, do you think in this asset class, there's, I don't know, a chance for higher returns, or is it just something that you kind of want to get into for an interest?
that's what it is. This asset class is a very stable asset class. People don't move that much.
Yeah, and people are just getting older. The baby boomers is very old.
Everybody's getting older. There's no saying about it. There's no denial on that. And people,
Population.
there's definitely higher cash flow, but it is more management intensive business. It is a business. It's just not. You give it to a property manager and he'll manage it. You have to have the right property. You have to have the right operator who can do it on the ground. If not, then you could end up in trouble very easily. It's not a passive investment. It is an active, very active. I'm sorry, very active business. And fortunately, we have some few operators whom we work with, and they are very active and very easy to work with. It has worked out well with us, and we have vision to do more syndication. For the bigger assets in this asset
of those. That's good. Have you seen COVID impact that asset class more, like for investing going forward? Because I mean, there's the reports that those kind of facilities have had like the biggest outbreaks and the biggest impact. So is that like a big concern for you, or is there like mitigation up front?
Yes, it has been some trouble with us also. I mean, knock on the wood, we never had even a single case of COVID in our facility yet.
That's
but
good.
we had to put strict measures to avoid input. Family meeting their parents and things like that. Not a lot of people were allowed. Our staff was being tested almost on a weekly basis, including our residents. So there is definitely an impact. It is difficult to get new residents. Because people are not trusting their loved ones to be put in the care homes, irrespective of your reputation in the market. So yes, there is an impact, but it is what it is. Maybe we will make less money as long as we are not losing, and knock on the wood, we are not losing. We are good enough. The goal is to continue to provide better care to our residents, providing them the quality care, and we are able to do that without any problem.
Yeah, that's good. That's really good. Before we transition to the last section of the show here, I wanted to ask you, what are a couple areas you're really focusing on in 2021 to scale your portfolio? I know assisted living, I don't know, maybe more value add acquisitions on multifamily. What's that look like for you?
The multifamily, like Indianapolis, that's where I like Indianapolis, Oklahoma City, Atlanta, Columbus, Kentucky. Some of those markets like Midwest, Southeast kind of markets, and South, like Oklahoma, Texas also. So there are some of the markets where we are focused on the multifamily side. For assisted living, mostly right now in California, and because of the presence of our boots on the ground Uh, Actually, our operator is in California, and then maybe Arizona and Colorado. So that's where we probably will end up spending our assisted living. We are establishing some relationships there. Our current operator is expanding into those markets also.
Yeah, that's interesting. I think here's a question that comes to mind. Like, I know usually if you pick a market, right, for multifamily, you're looking for the brokers in that market, the maybe the contractors, definitely the property management, because at that level of when you have a big property, you want a professional property management. But when you go into somewhere for assisted living, say you pick a new market, what kind of boots on the ground people are you looking for there right away?
See, two things. One is the realtors who deal in this kind of, it's like a broker relationship, right?
That focus on that asset class, yeah.
That asset class, because they know which businesses are. I mean, we don't do it from buy a single family and then try to take a license on it. We try to buy the business so that it is cash flowing from day one. So that, and we need an operator also. So two things. One is building and one is operator. Everything else is secondary, so to say, because
everything else falls into place if you get those two big things.
Yes, everything falls in place automatically, because there are always residents, there are always people, caregivers. Wherever you are, you will find the working class caregivers, and you can find easily residents, tenants. So no, in addition to that, we have to establish our relationship with the hospitals, things like that, agents who provide the residents also. So so all that needs to be done. So it is very management intensive. A lot of calls are made.
Yeah, a little bit more to it, but yeah, I mean, if it's a niche that has higher returns and there's really good opportunity there, then yeah, definitely warrants all that extra stuff.
Yeah, I mean, trust me, it is worth the efforts. I mean, you end up making higher cash flow on the property, and it's like having one assisted living home is equal to having 20 units, apartment complex, so to say.
Yeah, that's really interesting. I think it's definitely something people look into if multifamily is not working out, or if maybe it's getting too competitive for you and you can't find deals. Look at related asset classes, whether it's mobile homes or storage or assisted livings. Like there's other things that operate very similarly. They might operate more like a business, but if you figure out those nuances, I mean, the underlying principles, the cash flow, everything's the same really at a base level. So if you understand a few key principles, you can learn the nuances of each asset class and go forward and be really successful, like Prashant has been able to do so far. So I think that's really good. That's why I want to break that apart, because multifamily, I mean, I found it to be very competitive. It's hard to find good deals. I'm not that person just complains it's too hard, but I mean, for a lot of people, they're just like, you know what, I'd rather pivot to get to something that maybe has less resistance, but takes more work up front for me. So, I mean, everybody can get into multifamily. Like, I think real estate's easy. It's those like business aspects that are a lot harder.
Yeah, no, I totally agree with that. A lot, it has, obviously, for obvious reasons, multifamily has been very, very hard over the last couple of years, and people can jump into other asset classes, and that is one of the reasons why we were exploring assisted living. And I mean, knock on the wood, it is working out okay with us so far. And we do have intentions to get into other asset classes also. We are learning every day, like everybody else. We are establishing a relationship with the brokers and things like that to get into maybe storage asset class, maybe mobile home park, So everything is on the table. But primarily today we are focusing on multifamily.
Yeah. I love it because my job's like to inform people of how to like grow and scale in multifamily, but sometimes like how to grow and scale in commercial real estate and multifamily kind of related is just something kind of different, related, but different.
Yes. Yeah. Storage is very simple, asset class, you can have the storage with no employee and, but you can still get higher cash flow. There are a lot of storages out there. If you can buy one for yourself, you should buy one, because that's where you get higher, you don't need to deal with even for the management part, storage is something where you don't need full-time employee, with the kiosk and everything nowadays, with the technology, a lot of work can be done remotely very easily.
Yeah. Yeah. I like that. I think if you're one of those people where multifamily is proven just the competition is too much, like look in those related fields like storage or mobile homes or assisted living and dig in and find your competitive advantage there. Because it might be hard to in multifamily, but I think there's more opportunity to gain your competitive advantage rather than just like brute force, like head on in multifamily, like I'm going to be better than, whatever it is, just finding deals or whatever. So, I mean, there's ways you can be competitive in all of them, but I digress. So with that, Prashant, let's transition now into the last section of the show. This is the Fortune 5. These are the 5 questions I ask every guest, every show, and like to compare the answers. So
Fortune 5.
Question number 1. What is the biggest thing that has contributed to your success?
I think the biggest thing that has contributed to my success is my ability to give selflessly. When I started, I actually worked 6 months for free with a syndicator. I just did everything for him. That was my learning process, and that's how I learned like nitty-gritty details of this business.
Mm-hmm.
And I ended up becoming the partner on the deal with the syndicator. So I always keep that humble attitude in my mind, is to provide value to others. And when I am doing that, it comes back to me. Not that I'm expecting in any form of shape, but it just comes back automatically.
Yeah, it's just like the education. I mean, that's a form of value. You just throw out value and that comes back to you in force. So I really like that. I think if more people understood that and just would seek to give out value more than like trying to get value all the time, then they would find out, just like you're saying, they'd get it in return.
Yeah, there are a lot of people who don't understand it, and that's my message to them, guys. If you give something to others, you will automatically get it back.
Yep.
May not be now, may not be from the same guy, but you will get it somehow.
Yeah. And multifamily, it's always the season for giving. So don't forget that. But question 2 here, what's been your biggest mistake so far that's turned into a learning lesson for you?
Yeah. So in our first deal, we were a little naive, and we ended up having a private equity firm on our deal. And we shouldn't have done that in the beginning, because those who are professionals, they understand the naiveness pretty fast. So we ended up losing our deal. I mean, not that we lost our money, but we ended up giving our deal to them, because of course the deal was a little difficult, and private equity partner was not comfortable with us for whatever reason, so he retraded us, but gave us our money and gave us some money too, as the property in the deal together and everything.
Wow, so you guys brought in private equity for like a chunk of the raise on one of the deals, and then they ended up taking it over.
Yeah, I mean, that's my learning lesson. I never go for more than 50% private equity, because the moment somebody is bringing a lot of money, they want more control over the deal, and they want to assess each and everything in the deal. So that's my learning lesson. That's all I
like
can
that.
do.
So like keep a semblance of control to where you can direct your own money, unless you're going to be a passive investor, of course, and then choose the right people you want your money to be with. That's a really good learning lesson. If you're going to be the operator, don't just let anybody into your deal just because they have money and they can take, your vision away. And if you've got the better vision for the deal, then hold on to that. Good stuff. So Prashant, what's your favorite book you'd recommend to someone starting out?
So I read Joe Fairless's best ever book.
Yeah, he talks a lot about in there about giving value. And
I read that one, and that's the best book for this business. I think there's nothing else out there like that.
Yeah, that's actually, I think, the first or the second one I read when I was like making my pivot to multifamily. I was like, man, completely different. Got me thinking about like thought leadership platform and a podcast, and eventually, something else led to the starting of the podcast. And yeah, it's good book for sure. Not that you have to have a podcast, but really good book.
I've not started the podcast yet. You just you can choose what you can do or want to do.
Yeah, choose what fits you best. Yeah, I like that. So outside of closing all these deals and getting into assisted living and making a bunch of money, what do you like to do outside of real estate?
So I mean, as I said, I come from a humble background, and that's my superpower to give. And I meditate, and I help others to meditate, between peace, self-realization. So it's a free training that I offer to my friends and family members. I've been meditating for the last 30 years, and that's the only thing which I like besides being with my family.
I like that. Keeping in the humility. That's awesome.
Yeah,
Yeah.
that's it. Yeah, I spend a bunch of time, at least 8 to 10 hours a week helping my friends, whatever, to meditate and learn and be contemplative.
Very good. I love it. That's an awesome answer. So Prashant, that takes us to where can people find out more about you and connect with you?
See, myrealtygains.com is my website. If you go there, subscribe to my 7-day email course, join my Passionate Passive Investors Club just for education purposes, myrealtygains.com/PPIC. And I'm on internet everywhere, Facebook. My name is Prashant, Prashant at myrealtygains.com.
Yeah, we'll put all that in the show notes as well.
Yeah, that's all. You can find me anywhere. You can call me, text me, schedule a call with me on my website.
I love it. That's good stuff. Prashant, thanks for coming on the show. This was awesome. Love how you bring value and bring conservative and just good values into multifamily now and assisted living. And I think this is going to be a really good show for people to go back and listen to and learn from you.
Hey, Blake, thank you so much. Appreciate your time this morning, and you have a good day.
Absolutely. All right, we're out of here. Hey, thanks for listening. If you like the show, if you found value in it, please go to iTunes and leave a rating and review. If you want to check out more on your multifamily journey, go to multifamilyjourney.com, where you can get free resources to start your journey and figure out your path. That's multifamilyjourney.com. But more importantly, go take action today towards your financial future. See you next time.